In mid-September, the U.S. Federal Reserve Bank, or Fed, delivered a much-anticipated interest rate reduction when it cut the lower band of its overnight lending Fed funds interest rate target by 50 basis points, or 0.5%, to 4.75%. This was the Fed's first interest rate cut in more than 4 years since March 2020, when the U.S. economy was reeling with the COVID-19 pandemic. And while Fed rate cuts are often associated with concerning U.S. economic slowdowns, the Fed believes for now that this cut is preemptive, as despite slowing jobs growth, economic growth trends are tracking above 2% on an annualized basis. On the day following the Fed announcement, the widely followed S&P 500 equity index rallied 1.7%, moving to its highest level in more than 2 months and closing at a new all-time high. Equity investors appeared to cheer the Fed move, but do we expect the rally to continue? Here's how we're looking at that question. Many of the drivers of solid 2024 gains in U.S. equity markets remain largely in place. This includes growth trends I mentioned earlier, steady improvement or lower in year-over-year consumer inflation, and high levels of technology investment by companies. But recent employment data has softened. Jobs growth was positive through the summer, but the average monthly net new jobs over the 6 months that ended in August were at the lowest level since 2019. The Federal Reserve Bank's mandate is to set policy to support stable prices, which is inflation, and maximum employment, which is jobs. And in recent commentary, Fed Chairman Jerome Powell has indicated that policy has de-emphasized inflation concerns and is now focused on supporting the labor market. This means that as long as the inflation data remains in check, the Fed is likely to continue lowering rates at upcoming meetings. So cue the market rally, as rate cuts while the economy is still putting up good numbers is received positively. And in addition, the 4.75 Fed funds target rate is still relatively high, and if economic data does slow, investors believe the Fed will lower rates even more aggressively, providing stimulus. All of this could happen, but not all possible outcomes are rosy in our view. Weak labor trends can accelerate, and job losses often start with a ripple before gaining steam. Ultimately, this could impact economic growth, a slowdown or recession begins, and either scenario is likely to weigh on corporate earnings. This could materialize over the next 3 to 6 months in our view. For now, investor sentiment is high, but we are watching the labor market closely for signs of additional weakness. Building uncertainty could limit equity market upside from current levels and reiterate our recent message of positioning portfolios to expect improved relative performance from the average stock. So we want diversified sector exposure. That includes technology, but recent underperformance of that sector could continue. Rebalance portfolios by trimming highly appreciated positions and adding to their positions that have lagged. Scale back return expectations as the high double-digit percentage return of the S&P 500 over the prior 2 years is likely not sustainable. We like equity exposure, and the Fed is being proactive to acknowledge lower inflation and slowing jobs growth, but we believe a lot of good news is priced in. Stay diversified and expect more volatility. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.